Hello traders, Gary Wagner here. Approximately 11:20 in Honolulu, 4:20 in New York on Tuesday, 28th day of November 2023, and this is the Daily Report for gold and silver. A tremendously strong day for gold, a tremendously weak day for the dollar. Gold gained 1.31%, $26.60, taking the most active February contract to its current price of $2,061.80 after opening at $2,035. We did send out a trade alert yesterday to raise stops. Another one today. We'll cover that in detail when we look at some technical studies. As you know, when we first entered our trade at 1988, I talked about our exit strategy. The two best possibilities I saw was that we would see gold move either to 2040. It's based on a double top. The first occurrence on Thursday, the first day of June, right here. And the second occurrence more recently at the end of October. We saw gold move up over the last 3 trading days, large green candles, higher highs, higher lows, and today a tremendous surge above this one support level that corresponds to the double top. That was the reason we sent out a trade alert yesterday as well as today. Currently, we are looking at resistance at $2,080. Of course, at any moment, traders could pull profits and take this market lower. And above that is just about $2,100 per ounce, a few dollars above that. And that is based upon this high. This, of course, is a daily candlestick chart, and it does show our entry price at $1,988. Our initial stop we have already taken out. I've put our former stop, and this is the stop that we moved it up to yesterday, which was $2,026.30. I felt that the move we saw yesterday could at any moment turn to a scenario of selling pressure as we were closely approaching $2,040. At that point, I was labeling this as potential resistance. Of course, today we barreled through there, opening up at 2035 and currently trading well above that past 2060. And that's what precipitated me moving the stop in a single day from 26 to our new stop. All traders should be long at $1,988 with stops at $2,044.50. We are now at a fairly critical point because, as you can see by this red line, there could possibly be some resistance. I am basing it upon this level of support. This came back in April, in which we had reached our first set of all-time record highs, and we came down to this level and then rose to the highest level gold has ever been to. Based upon that, we could find resistance here. And if we do, it could break down anywhere between these two different support levels at 2050 and at 2037. That being said, effectively, if we get a continuation of this rally, there is really no technical resistance until it reaches about $2,100 an ounce. It could stall at 2,080, but on a technical basis, it appears as though an effective close above this price point and further buying in the subsequent days this week will take it to test 2,080. In either case, we have protected a good amount of the profits, getting in at 88, locking in the differential between 1988 and 2044, but I do hope that gold moves higher. It has really been based upon a couple of things: the continued geopolitical crises that are occurring in the Middle East and Ukraine, as well as other hot spots in the area, Yemen being one of them. They fired apparently a cruise missile against a U.S. warship, along with multiple strikes against military installations in Syria. They are desperately trying to get the United States involved in a crisis that so far has been contained between one country and two different parties. We are hoping that it stays contained to that, because the ramifications of it expanding are more than anyone wants to imagine, conceive, or see realized. Currently, I do find that major support occurs at the first double top at approximately 2,040. Our stop is just above that. If gold does hold that level, as I said, we've already looked at 2,080 and 2,100 per ounce. I want to convert our candlestick chart to two other types of Eastern charts. The first one is a Henkinashi or Japanese average chart. You can see that the body size has been enlarging. There are no lower wicks unless we go back in time to approximately the 20th of November. This signals the potential for more higher prices based on this chart. The other chart that I want to look at is a three-line break chart. We can see that it is showing us by this color change on the last candle that it is predicting, based upon this type of chart, that we could easily see higher prices. Lastly, I do want to take a look at the dollar. You can see that over the last 3 days, we have seen the dollar index trade to a lower low, lower high, and lower close than the previous day. Of course, these 3 days are in context of the fact that the dollar index on the first day of November was well above 1,006. It is now well below 103, approximately a 3% decline in the dollar index, which is a strong trend. In terms of a technical level, we did have support right here as well as right here, and we have technically broken below those points, which means that we could go into a free fall. That, of course, is only based on the technical studies that we look at. Anything can happen, but it does appear that the weakness that we have seen since the beginning of November in the dollar index could in fact continue and mark a further decline. Therefore, traders, my recommendation is to maintain your long position at $1,988. Maintain the new stop at around $2,044. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.